Hi everybody, this is Dimo Gonzalez of Heartwood Financial Services. Hey, thanks for joining us for our latest market update and outlook video. So we've had a pretty good run here in October, but the beginning of November has been a little choppy, as you can see from my footage here. We're going through a little bit of a storm, but the market's been pretty resilient so far. So I want to talk about, are there some cracks forming, or is the market holding up pretty good? Let's get going. All right, as always, let's get started with the asset class returns for the month of October. So in the blue, we're looking at the year to date, and as you can see, it's been a pretty good year to date. The green is showing all the current month for the end of October. A couple highlights would be large cap stocks were up again, 2.34%, mostly led by large cap tech, which has been doing very well, and we're going to talk more about that here in the outlook. But small caps have actually not done quite as well for this month. They actually had a pretty good run the last few months, but took a little breather this time. Real estate's been down. We had interest rates kind of flat, but went kind of up towards the end of the month. We'll talk a little bit more about that here in the update. But then you're also seeing international's been very strong. Now this is with the dollar. The dollar's been pretty good. It's actually gone up a little bit, and it still has gone up. So that's a very good sign. In particular, emerging markets. As you know, if you watched our video last month, we've been adding a little bit more of the emerging markets, so that's been good to see. And we're seeing that, China and the U.S., they're trying to play a little nicer with trade, although it's not going perfect, but at least it's going in the right direction, so that might be part of what's helping it. And the fixed income markets was pretty much flat, just like rates. And then again, commodities have been doing very well, especially precious metals. Pretty much all of this is because of gold. And we're seeing a lot of that came in this month as well. Actually would have been more. Gold actually took a pretty big hit towards the end of the month, but it was still commodities up quite a bit. All right, for the market update, let's start with an update on what's going on with the Fed. They just had a meeting in October. They went ahead and lowered interest rates by a quarter point, so that was nice to see. So now we're at 3.75 to 4 in that range. And they also did something that a lot of people aren't really paying attention to, but they are freezing the balance sheet. And I got a picture of the balance sheet here. So what the balance sheet is, the Fed has been buying bonds. When they buy bonds, they're increasing the demand for bonds, and that makes their yields go down. Okay? And so since they have all these bonds, they've been trying to reduce the balance sheet, and they have actually been successful. They've been lowering here. As you can see, the balance sheet has actually been getting a little smaller. So as these bonds mature, they're just letting them mature, and they're not buying them back. And that's actually making interest rates kind of go up a little bit because there's less demand for bonds. So now that they're saying they're going to freeze the balance sheet, they're going to start buying some of those bonds that mature back to keep the balance sheet the same. So this is also a kind of a dovish move to freeze the balance sheet, because the next move is probably to start increasing the balance sheet again, especially if interest rates don't come down as quickly as we've been hoping for. So again, this is a very good sign. The Fed is pretty dovish. Now, they came across as a little hawkish. During the meeting, they said they were cutting, but December's not automatic. So they spooked some of the investors, which is why we saw interest rates go down, and then they kind of spiked up at the end of the month. But I think they're just trying to kind of talk down the market, because they had about a 90% probability of December, and I think they're just trying to reduce that probability. They want to be predictable, but not that predictable. All right, and here's a quick take on what's going on with inflation. As you can see from this graph here, we had pretty high inflation back in 22, 23. We've been coming down progressively. It's been a nice drop. And right now we're right around 3% on both the core inflation and the headline inflation, which is actually a little bit up from where it was earlier in the year, but basically back to where we started in the year. So that's a little disappointing. As you can see, some of that has to do with food prices kind of going up a little bit and staying sticky and high. And just all the items in general. Energy has been down a little bit, but basically all the other items, including goods, has been kind of sticking around 3. And so, there's probably some effects to what the tariffs have done. If it wasn't for the tariffs, I've heard that inflation would probably be down to about 2%, or close to 2% by now. And so we're seeing a little bit more sticky inflation, probably mostly because of the tariffs. All right, and then my big 3 economic indicators, you got the manufacturing survey, which is showing a little bit lower trend, down to 48.7 from 49.1. So that's not a big surprise. It's down a little bit, so that's disappointing. But that's actually been below 50 for a little over a year now, so it's not a super ominous sign at this point where it is. The ISM services number, which is a much bigger component of the economy, is much more important. And so you saw the previous was right at 50, right at the flat line of, growing and contracting. But it actually went up to 52.4. So that was actually a really good sign, showing that the economy is still, doing pretty well. We'd like to see that number bump up even more, but at this point, it's a positive and we'll take it. And then the last one has been the unemployment numbers. As you know, the shutdown has been going on. I'm recording this on a Wednesday afternoon. Right now, they're actually doing the final vote, I think, in Congress. So hopefully when you watch this video, the government will be open. But we are working with the numbers that we got right now. And the only ones that we have for unemployment is the ADP, which is a private payrolls report, much smaller report. But they did show that things were negative last month, and then they went to positive 42,000 for this month, which is not a lot. And, these numbers, we don't really know how accurate they are because we don't have a lot to compare it to relative to the normal government data that we get for the employment numbers. But it shows that the trend is still favorable. I would say it's a little weak, but not horrible. All right, last thing for the update. This was a big event that happened in October. I wanted to just touch base on it real quick. The question is there a credit problem? There has been some bankruptcies that have affected some regional banks. Tricolor, which is financing automobiles. First Brands, I think, is kind of a manufacturer. They have parts for automobiles and things like that. So what's going on here is both of these companies, it looks like basically there was fraud involved in how they were doing their books, and they were accounting for the assets that they had. They were double counting things. So there's some kind of shady business going on there. And so it seems like maybe these are one-offs. So I would say the 3 points that I would make about these, because these have been the highest profile ones that we've seen as far as bankruptcies, is they're not big companies. Most of these you probably haven't even heard of. They did affect a couple regional banks that, again, are not real big banks. The other banks reported great earnings, so it's maybe an anomaly, not just some sort of trend. And then again, like with 2022, when we had that Silicon Valley Bank situation, the Fed can step in like they did and kind of help out and make, grease the wheels a little bit of the banking industry, especially when they're not considered very big bankruptcy. So again, something to kind of keep an eye out for. I'm not sure if it's a canary in the coal mine quite yet, maybe just a little blip, but it is something to kind of keep an eye on and make sure that we're not starting to see credit markets breaking down, which I don't see quite yet. All right, in the outlook, I wanted to talk a little bit about volatility. We've seen a little volatility here in the beginning of November as I'm recording this video. So I wanted to talk about how volatility is normal. It's part of investing. We've been a little spoiled over the last few years, especially since April. We haven't really seen hardly any volatility. It's been pretty steadily going up, which has been nice to see. But really for the last 10, 15 years, since back in 2008, we haven't seen a lot of volatility. And it is pretty normal. This chart here I found had the drawdowns of the S&P 500 since 1950, so about 75 years of time here. And you can see the market goes down 5% basically about every year, okay? And we did get a drawdown like that this year, although we didn't get one like that last year. So it's been, it's pretty normal when you see 5% drop. And now the numbers are a lot bigger, so they get a little scary sounding when they talk about the Dow going down, 1,000 points or something like that. But the Dow going down 1,000 points is not even a 5% move anymore. It's at 48,000. So what's 5% of 48? That's like a 2,400 point move to see a 5% drop. And so it sounds really bad, but again, that is a normal thing that happens every year. And even a 10% drop, you can see that only happens, that happens about one every 3 years. And the 20% drop and 30% drop, those are very rare, but you can see, they happen. You were going to see a 30% drop probably within your lifetime, maybe even a 40% drop. So this is why we diversify. This is why we try not to time the market. We use an allocation that buffers and has non-correlating assets, right? All right, for the last part of the outlook, I wanted to talk about what has been holding up this rally so far, and I give you my thoughts on how it's going. And I've been summing it up with these 4 pillars, so I call it 4 pillars of the market rally. So the first one is AI enthusiasm, okay? And I'm not talking about AI hype, but the actual enthusiasm of what artificial intelligence will be able to do for the economy with new technology that's going to revolutionize how we do a lot of things, make us more productive. Now, it maybe has gotten a little overhyped here recently, where we're seeing a little bit of those stocks get taken down just a little bit, but that's good to see. When you have a lot of skeptics about technology, that's healthy, because back with the internet bubble, we didn't see a lot of that, and it got a little out of hand. So I'm happy to see some movement in and out with the AI, but I still believe that we are early in this process, and we probably have a lot more to go there. On the second pillar, we have stable growth. We have been seeing some cracks with the labor market. I was showing you in the Big 3 report. But overall, everything still looks pretty solid. And if we get some stimulus from the tax, the tax stimulus with the One Big Beautiful Bill that really starts to kick in probably in 2026 when people start getting their refund checks, etc., that could actually even create a nice little tailwind for that growth. And so I'm still pretty optimistic on that front. And then falling rates, that's been a nice backdrop for the economy. As interest rates go down, it makes borrowing costs go down. It just makes it easier for consumers to buy things and for corporations to finance things. And that continues to be the trend, even though, Powell threw a little wrench in, December. But I still think they're going to, if it's not December, it'll probably be January, and maybe even a few more hikes next year. And then the last piece is relatively trade stability. So, we've seen a lot of non-stability in that category here recently. But it does appear that more deals are being made. We have a better understanding now of the policy. The tariff policy with Trump was more of a negotiation tactic. A lot of deals are coming through, and it is starting to look like it's not as bad as we thought. In some cases, although a little bit worse than others. And the deals are coming through, so things have stabilized. I'm still a little nervous about China, but it does seem like we're talking and we're making some headway there as well. So as you can see, all four of these pillars is what's been causing the market to do pretty well. They still look pretty good. There is a few cracks here and there showing, but overall they're holding up. So as long as these pillars continue to hold up, I think the market will continue to move forward. With the prices getting as high as they are with the markets, that could be the new pillar that I'll introduce next month, because it is starting to get a little pricey, but still not too bad. And I think we can continue to move in a positive direction for the markets with these pillars. All right, finally, the Hartwood implications. So here we're looking at still a neutral positioning for the portfolios. As you saw, I'm pretty optimistic about things. I showed you the four pillars are still holding up, but the market has been getting a little pricey, and I know that's not a very good way to time the markets, with valuations. They're horrible for timing the markets. But when things get a little expensive, I always like to get a little bit more careful. So that's basically where we are right now. I'm still reducing small caps, adding a little bit more to emerging markets. I've pretty much finished doing all that with the portfolios, but I still wanted to leave that on the page so you could see that we've been doing that. But that's pretty much it. If you guys have any questions, as always, I'm here to answer anything that's on your mind. If you want to share this video with your friends or family, that would be great. I would appreciate it. And I hope everybody has a wonderful Thanksgiving. God bless. Bye-bye.